Welcome to Real Estate Exposed, helping people in San Diego buy, sell, and refinance their biggest investment, delivering you timely truths, exposing important issues, and helping you get into the right home. Here are your hosts, real estate expert Daniel Beer, top-ranked professional by sales volume at one of San Diego's largest brokerages, and his mortgage partner, Todd Pianin, with over $2 billion in funded loans.
Hey, what's happening? It is Real Estate Exposed here on News Radio 600 KOGO. Another beautiful Sunday morning with your hosts, Daniel Beer and Todd Pianin. What's happening? There's a lot going on in the world. Everything continues just being absolutely bananas out there, Todd. The world is not wanting to become normal again.
It's not. Well, people are treating it like normalcy, but it's really not.
That's the biggest issue, huh?
Yeah, exactly. I mean, we had, 2 police officers in San Diego County shot. One died last week, and you looked through the headlines, we can't even find it anywhere.
It's amazing. Todd, you're the one that told me about this. I hadn't heard about it anywhere.
Right.
I jump on CNN.com. There's finally, once I scroll well down on the page, a little blurb, a little tiny snippet in which I finally access the story. That's scary, man. That is scary. I mean, how is that not just boom, front and center? And it's because this kind of thing is normalizing, and that's not the world that I want my son to live in. You know, I have a 2-year-old, and that's a really scary thing for a dad.
It's not the world I want my son or daughter to live in. I mean, it's unbelievable to me. I mean, we've got these law enforcement officials who basically, they put their lives on the line every single day, and God bless you guys for doing it. And I'm sorry that it's not all over the news. And, our hearts and prayers go out to the families that it happened to. So, but, lots of other stuff happened this week too, Dan. I don't know if you're aware, but the Fed came out this week. Came out on Wednesday, said they're leaving interest rates alone.
Of course.
Leaving interest rates alone again.
Which is what you've been saying they're going to do.
Exactly. I said they're not going to raise this year. They did allude to the fact that they may raise rates at some point, but it was a minor little blip in their dialogue. And we've seen rates come down, and also GDP numbers completely missed on Friday. I mean, we're not even talking. It's like shooting pigs in a barrel. It was like they completely missed.
Which falls right in line with the feeling we have and what we see. It's not even a feeling. I take that completely back. With what we see, which is the beginnings of a shifting market. So we're going to talk more to you today here on Real Estate Exposed about the new market that's coming. Before we really jump into it, let me remind you, we are here on News Radio 600 KOGO, Real Estate Exposed. I'm Daniel Beer, Daniel Beer Group. That's beer spelled just like the drink, Keller Williams Realty, and Todd Pianin, Home Street Bank.
And we have a special guest in studio today.
In studio today, we have Michael Khalil. What's happening, Michael?
Hey, guys. Thanks for having me.
It's awesome, man. We're happy you're here. Michael's actually the president of Mac Financial. He's a CPA. We're going to be talking real estate accounting. Does that sound exciting to you? It should be. Okay, here's the issue.
Super exciting to me, Dan. I mean, I can't imagine anything more exciting than having a CPA in the studio.
Let me rephrase that for you. We're going to talk about how to save money on your taxes, what deductions you should be looking for that you're often missing. What about vacation homes? How do you take advantage of them? Deferred taxes versus paying now and going into the future tax-free. We're going to pick Michael's brain, and once we reframe it that way, Todd.
Now it sounds exciting, Dan. Now I'm pumped. Michael, are you pumped to answer those questions?
Now we're talking about saving money.
Good.
Now we're talking about saving money, making money, and being smarter investors, smarter business people.
Thanks for coming in on a Sunday, too, Michael, which I'm sure is probably the only day that you have off during the week. So thank you very much.
And I'm just curious, Michael, actually, to jump in. We're talking about these low interest rates that we have. The Fed has announced they're not raising them, at least not right now. Does the interest rate environment affect at all what you see or how you approach your work as a CPA, what your clients are doing? How does it affect you in any way? For all I know, it does, or it may not.
It does. It does in a sense. I mean, when you're a homeowner, you're looking at your interest deduction, right? And you have a couple things that come into play. As a homeowner, you have your interest deduction, you have your real estate taxes, and those are deductions that go straight to your Schedule A. If you're an investor, you're looking at interest rates as far as caps and how you're going to get your investment property to be more profitable. You're looking at your Schedule E, and those are direct deductions are coming to your bottom line and affect your tax return as well. From the homeowner's perspective, you're looking at your Schedule A forms, making sure you're getting those deductions, and they're flowing right to your 1040.
So just to jump in real quick, because I want people to be able to follow up with you if they don't know what a 1040 is or Schedule E, et cetera, right? Because it's complicated, yet it's also simple, or at least you make it look that way. And especially your clients that we've spoken to that are happy with your work, they make it sound that way, or at least, that's how you make them feel. So in order to reach Michael, if you want to jump into, if you own property, period, let's start there, okay? If you own property, if you own real estate, get in touch with Michael, talk to a CPA, because it's the greatest probability is you're leaving money on the table somehow, some way by not taking advantage of the tax code. And in this context, taking advantage of the tax code is completely in line morally by the letter of the law. But it's amazing how the law actually affords you tax deductions that you're not always using. And then what do? We go and complain about taxes.
Well, the funny thing
Right?
is,
That's right.
the funny thing is that we see people's tax returns all the time. They do them themselves, right? So, like, to me, I'm sitting there going, you don't realize how much more money you'd be saving if you just hired someone like Michael to actually do your taxes.
That's
for
an
you.
interesting thing. And by the way, let me give Michael's phone number out very quickly, and we're going to jump in. That's a very interesting question it'll lead to. But phone number, if you want to reach Michael, 858-263-1770. Todd and I, as your hosts here every week, we're committed to vetting out top-level professionals that we would entrust our own friends and family to and introducing them to you here on the radio. The number for Michael is 858-263-1770. So, Todd, what you just said really made my ears perk up, because on the real estate side, we see the tragic mistakes that are made by for sale by owners.
Right.
People that believe they're quote-unquote going to save the commission, and they do it at the expense of just annihilating their bottom line and netting less money.
Right.
And then we talk about those issues.
We talked about that on the show
And
before.
is there basically, Michael, in the in the accounting world, there are so many people. I've never done my own taxes,
Right.
but there are so many people that do their own taxes. Is it kind of like just as big a mistake as we see in our field when someone does it for sale by owner? Talk to me about what someone doing their own taxes could expect versus someone doing them through a professional.
When you do your own taxes, you're limited to the knowledge of what your experiences are, right? So you don't really have the experience of a knowledge professional who's seen your situation and other situations go and play and how it plays out. I mean, I've seen countless tax returns that have missed depreciation. I mean, this is thousands of dollars deduction depending on the value of the building for years. And once you miss depreciation, you don't get it back.
What do you mean by depreciation, Michael? Because our listeners sometimes don't understand. So if they own a building, or they own an investment property, or they own a second home, what do you mean by depreciation?
Yeah, define that for me.
So if you have let's say you have a commercial building,
Right.
you're depreciating that. You should be depreciating that commercial building over a certain period of time. You get a little bit every year, right? So a little bit of the building.
So you can deduct some percentage of the building off of your tax returns?
Correct.
Got it.
So you
Okay.
get that percentage. It hits your, depending on the type of form or the entity or the structure you have that, and you'd get a little deduction there. Now, the IRS has a use it or lose it policy with this depreciation. So many people think, I'm just going to save it. I'm going to save my depreciation till the end, and I'm going to keep my basis in the property. And then when I go to sell it, I'm not going to pay any taxes.
You see that a lot, huh?
All the time. And it's sad because you end up having to break their heart, and they found out now I paid taxes for the last 20 years on money that I shouldn't have been paying taxes on, and I have to act like I took the depreciation in this transaction when in reality I never did, and I lost it all. Now there's ways you can come back from that, but they're costly, and you have to have documentation to provide to show that, hey, I never took this depreciation, and you got to file it on time. Generally, I mean, your average person filing the return, they're not going to know this. They're not going to have any way of finding out unless they're digging deep into the code to find certain regulations that are going to allow them to pass by and file these forms to get their depreciation back or carry it forward. By then, it's usually way too late. These are things that you get the advantage of a tax professional.
So what about somebody, though? This is somebody that owns a commercial building or real estate. What about the average person out there that's just gonna, they're working a job and they're feeding their family and they have a 9 to 5 kind of thing and they're W-2'd, and should somebody like that, how critical, and it may, for all I know, it may not be, how critical is it that somebody like that reach out to a professional? What kind of mistakes can they run into?
They can miss deductions on their Schedule A, common form that's filed with any homeowner. You're paying your mortgage.
What does that mean? What's Schedule A?
Schedule A is your itemized deduction worksheet. Pretty much lays out any deductions you'll be getting as an individual or married filing joint taxpayer.
So what kind of deductions are out there for kind of the everyday man that are sometimes missed?
Your interest, mortgage interest. Right now they raised the medical deduction up to 10% of your AGI for most of us, so it's not really going to affect us all, but it's there. Your 2% of business expenses.
So there's something like that, and then there's certain things that could be classified as a business expense that not everybody realizes would have been classified as a business expense.
Absolutely.
Is that right?
Absolutely. If your company has an accountable or non-accounting program.
Got it. Well, listen, we're going to head in the break here, but coming up next, you're going to be back here on Real Estate Exposed with Daniel Beer, Keller Williams Realty, Daniel Beer Group, and Todd Pianin, Home Street Bank. Your hosts here on Radio 600 KOGO, Real Estate Exposed. Hey, we're back here, Real Estate Exposed. Daniel Beer and Todd Pianin with our special guest, Michael Khalil. Michael Khalil of Mac Financial, CPA, and we're talking about saving money using deductions, not making a mistake of basically being the equivalent of a for sale by owner, but on the tax side. And what I have found over the course of my life is that anytime we're using ourselves to do what is very high level, professional, intricate, specialized work, the downside is far in excess of the upside. Michael, you're talking about this. I mean, this is complicated stuff. I mean, to you it's simple, but Schedule E and the 120 and the this form and the that form and the deductions and the itemizations. How do you go about doing this yourself? I don't get it.
I mean, it's amazing because, both you and I have gone through transformations in our businesses by bringing on other people. You know what I mean? Bringing on experts.
Specialists.
Right? Specialists. I mean, you have an operations manager now, which you never had before. I've got a marketing person, full-time partner, and all kinds of stuff. But these are things that Michael, you probably see stuff every day. I mean, has someone ever walked into your office and like done their returns themselves for like the past 2 or 3 years, and you went, I'll use one of Dan and my phrases, "Hey, Vay, what did you just do?" I mean, how much money you just left on the table that you didn't realize you could deduct? I mean, people don't realize they can deduct property taxes. I mean, even you and I talked one night. I was over at Michael's house a couple weeks ago, and we were talking about where they're living and where interest rates are and how low they are right now, and if they were to buy in the building they were in, and what they're paying rent versus buy, with interest rates, and I mean that must happen to you all the time.
It does, and sometimes you can help the client. I mean, you can look for opportunities for them to fix what they've done. Sometimes you can't, and you have to break it down to them. It's important that you get the right person to do the right job. I wouldn't hire a general practitioner to do my heart surgery. I would want a heart surgeon to do my heart surgery, right? Just like you don't want just some Joe Schmo selling your property. You want the best real estate agent in the business selling your property. They're going to do the job. They have the experience. They have the know-how. We have the eyes to look at taxes. That's what we're trained for. That's what we do.
So what are you seeing in the world of vacation homes? How can vacation homes, either what mistakes are people making there or what opportunities are there for tax advantage in savings if somebody is thinking about I don't know if a second home would qualify, if it actually be classified a vacation home.
So, of course, there's some intricacies with vacation homes, and as far as how people treat them. One of the opportunities that are available for you is you can 1031 it if you classify the vacation home as a business use property. Now, there's certain...
So what is a 1031?
1031 is a deferred exchange. It's a way where the seller of the property can defer their gain into the next property.
So if you've purchased an investment property,
or you've purchased a second home,
and
you've decided to rent it out for, say, a year or two, you have to rent it out for
at least 14 days.
At least 14 days a year, then you can turn it into. Then you can 1031. So if I bought a vacation home and I rented it out for 14 days, and I bought it 15 years ago for the sake of argument, but my wife is begging me that she wants something nicer that we can vacation in, and I've got all this equity built up, but I don't want to pay taxes on it. You can
1031 it. There's certain limitations on how long you can use the property.
1031, it means I'm going to sell that property, purchase the move-up property.
You're going to trade
move
up.
all of my gains into the move-up property, tax deferred.
Correct.
Which is important for the listener to understand. Tax deferred, not tax free.
That's correct.
Right? So you're moving that gain into. So basically, the government is kind of participating in the down payment with you for the new bigger property.
You're just kicking the can down the road a little bit.
So what happens with these guys that 1031, multiple property? We're talking dozens of times over and over and over and over and over. Like, at what point do the taxes come due? At what point, and when these guys die eventually and pass and inherit the properties to their loved ones, how is there not just a massive tax bill that goes along with it?
There's a couple things that come into play. You have your estate taxes. You have your estate tax limitations, which is going up every year. If the value of that property is exceeding that limitation, then you're going to see some estate taxes on that property. But when someone dies, the valuation of that property, the fair market value of the basis, is stepped up. So the person who's
you literally can just kick the can all the way down to the coffin
if you want.
I mean, that's something I didn't know about. Did you know about that, Dan?
I know people do that. What's never been clear to me is, then what? I mean, doesn't the government always get theirs eventually?
Apparently not. I mean, it doesn't sound like it. I mean, right? I mean, if the estate's worth, if you're raising up the fair market value, right, and the estate is you're worth less than what you have to pay in estate taxes, you can actually save those taxes that you've been kicking down the curb.
Like, this is the reason you just need to reach out and call Michael, 858-263-1770. And you're listening to Real Estate Exposed here with Daniel Beer and Todd Pianin. If you want to reach Todd or I, talk mortgage, loans, man, rates. Here's the thing. And I'm going to laugh here for a moment, but it's only out of frustration and out of empathy. I just don't know what else to do, because I know we're going to be back in the studio here. It may not be 2016. It might be a different year. Might be 17, or it might be definitely be a different month. But at some point, we're going to be in the studio. The content we're going to be sharing with you in the studio at that future date, which is not that far away, will be all about the window, that time, that time with those
low
rates.
Interest rates.
You know, hey, Todd, remember those rates? Yeah. Remember. What were? Oh my God, really? Yeah. We're going to be having that conversation.
Yep.
And you cannot own real estate in this era. Right now, today, you cannot own without talking to somebody like Todd about a refinance. You also cannot be in a position where you're thinking, gee, I might buy a year from now. Todd, coming up out of the break, is going to share some eye-opening information with you as far as the difference that a rate change can make. And when I saw this, my eyes just about popped out. You're going to hear what it would have cost to own or to make the identical payment through different times in our interest rate history. And the purchasing power afforded to you today,
where interest rates are,
by your beloved U.S. government and our big banks, including Todd's very own Home Street, who, by the way, knocked the snot out of any of the others as far as service, performance, and timeliness. You have to make that phone call. Call 800-676-24 800-676-2420. And by the way, if you want your home value, there's no other place to go for an instant home value than valuesinsandiego.com. What's up? We're back. Real Estate Exposed, Daniel Beer, Todd Pianin with Michael Khalil in studio today from Mac Financial Inc. CPA, and like Todd and I love to do for you, we will vet out professionals in the San Diego County market that we would be comfortable referring our friends and family to. That's what you are to us. And Khalil Mack, CPA extraordinaire, Mac Financial. Give them a shout, 858-263-1770. Now, we're fresh on the heels from this bonus round home selling workshop that we did just this past July 27th, last Wednesday. It was awesome. Packed house.
Standing room only, actually.
Loved every moment of it. It was awesome just connecting with all these people, some of which who couldn't get tickets the last time we had a workshop. And, Todd, what were the biggest ahas for you?
The biggest ahas?
Yeah, when it comes to the process of smart home selling.
So let me tell you the biggest aha, because I read a lot of the comment cards. And so the biggest aha was, and I'm putting you on the spot right now, but I think that we need to do a show that basically I interview you. And the biggest aha was because a lot of the people came out of there going, the things that you were giving away for free, because you gave the whole presentation away for free, and talking about how you sell homes and how you're number one, and you don't like to talk about, but number one being San Diego County right now. I mean, the aha moment for me was people were just blown away by all the tips, the psychological stuff that you do, and how you got to the point. The question that people kept asking me was, how did he come up with this? You explain it during the home seller seminar, how you kind of came up with it. But I want to kind of do a whole show around a deep dive in your career, because, you only changed the way you did business in the last 3 or 4 years when you came up with the 5-day marketing blitz and that kind of stuff. So the biggest aha moment for me was, we really need to get down to, why is Dan Beer such a disruptor in the real estate space, and how did he get to this place?
Got it. I'd love to do it. I'd be happy to share. And it was definitely a long journey.
What was your biggest aha moment?
For me, it's just some of the questions, and I say this delicately. Okay,
we got a lot of questions.
Some of the questions coming from the people in the crowd. Some people really getting the concept and the content, and just how we need to have a completely different approach in the root of the psychology with which everything else is born. But even with the high level content that was being shared as far as how to intelligently sell your home within a 5-day period and do it predictably, how to get a full market response rather than just getting individuals creeping in and out of your home one at a time, how to use that in your negotiating advantage. And then we'd still, at times, would get questions regarding, things like flyers and just really basic stuff, which still tells me that if even the people in the room get hung up on that kind of stuff, then the general public, and no fault of yours, absolutely fault of ours as an industry that unfortunately goes through such little amounts of education in order to attain our license.
I mean, how many hours?
There's just so much misconception around what matters and what doesn't, and what leads to a successful home sale.
Right.
It's striking. And it's scary, and that's why I'm committed to continuing the workshops into the future.
Well, yeah, we have to.
We have to
push it out there. I mean, Mike, how many hours of education did you have to be a CPA?
I don't think. I mean, we're talking years.
Years?
Yeah.
How many hours? How many hours do you think it took Dan to be a licensed real estate professional?
I couldn't tell you.
It's a joke, man. It's 135 hours, and they're not even real. Yeah, Mike's shaking his head. He can't believe it. He got in the wrong business, and they're not even real. They're just not even real. They tell you it's 135 hours. The reality is they just send you some books in the mail. They tell you can't take a test. Let's be clear, there's the state test, but there's passing the courses necessary to be able to take the state test. Those 135 hours of education to be eligible for the state test are BS. They're fake. They just send you a bunch of books in the mail, and then you take an online test, open book, that you are just not allowed to take more than one of them in any 24-hour period. So that 24-hour waiting period from when you're going to take one to take the other is considered 24 hours of education. How's that for a joke?
You're handling hundreds of thousands, potentially millions of dollars of somebody's nest egg.
It's unreal.
And Mike, you're doing tax returns for people, and you had to have years of experience before you could get your license.
You can't even sit right now. They up. You can't even sit for the exams to qualify without a master's level of education. You need a master's degree just to sit to qualify for the exams.
And that's the way it should be. And doctors and lawyers and everybody that handles high levels of just highly sensitive matters, whether they be health matters, financial matters, legal matters. How is it that a person's biggest investment, their nest egg, their retirement, their inheritance to their children, is entrusted on a regular basis to people, myself included, by the way? I don't have any kind of special degree. Not at least an official one. I do have a special degree. I'll describe what that is in a moment. But on paper, 135 hours of education, it's absolutely ridiculous. And that's why there are 23,000 agents just in San Diego County alone.
2 million agents in the country?
2 million, yeah. And so at the end of the day, it's the American public that suffers, because the reality is that America's homes are being sold in the grand majority of times, not always.
Right.
And there are other good professionals. Let's be clear.
100% clear.
Let's be clear. There are other top-notch professionals out there, but the majority of America's homes are sold by hobbyists. How's that?
Mike, did you realize the average realtor in San Diego sells 3 to 4 homes a year?
So that's a broken process. When we tell you that the real estate, that the selling process, that the home selling process of the traditional agent is broken completely, it's not because of any. You don't have to look beyond the conversation we just had to figure out why. At these workshops and what we do with people one-on-one when we're called out on appointment, and if you want to know how, give us a shout. 800-676-2420. Okay, 800-676-2420. What we've now taken to market, and the market has responded very well. I mean, we're on pace to sell over 220 homes this year, while the average agent will do less than 4. What we've taken to market is a proven process to systematically have a home sold within 5 days of going on the market. Okay? That is an entirely different approach and a different way of thinking about it. And in fact, we're so confident it works so well that those that choose to take us up on our guaranteed sale program, which you're more than welcome to ask for details and conditions on, which do apply, but the people that we will actually guarantee to sell a home at 100% of your asking price within 29 days, or we'll pay you the difference. And again, there's conditions and terms that apply to that minor, but you have to give us a shout. And here's what'll happen. Worst case scenario, you'll hear something completely different and learn something new. Best case, you'll finally leave behind the incredibly flawed process. And using the word process is too much a compliment, frankly. The incredibly flawed process by which America's homes are vastly sold by 135-hour educated hobbyists. In our industry, it's in the field that you get your degree. That master's degree you got, Mike, you have to get it in the field. You have to get it through professional service at a high level over an extended period of time, so you don't cost American families tens of thousands of dollars. We're going to come back, and there are people whose homes have expired, gone off market, unable to sell, reaching out, asking why and how You need to hear it. We're back with you, Real Estate Exposed, Daniel Beer and Todd Pianin. Lots of business to get to before we end the show today. We have from Freddie Mac. And this is courtesy here of Todd Pianin and his team at Home Street Bank. From Freddie Mac, Todd.
You may explain the slide.
This is unreal what you've shared with me.
Yep.
And we have to change course on our plan today with our audience. And they need to know what I'm looking at.
Yeah, so we'll get Camille to post it on our Facebook page, so you can find us on Real Estate Exposed. But if you look at 1985, interest rates are trading right around 11.5. If you want to keep your payment, again, we're in a different market, so let's just use these numbers as just a rule of thumb. You want to keep your payment about $995 a month. That gave you a purchasing power in 1985 of $100,000 in loan amount. In 2000. The average interest rate was 7.54%. Kept your payment right around the $995. Turned your loan amount power to about $142,000. In today's environment, with an average interest rate, 30-year fixed, of 3.93, same $995 payment gives you a max loan amount of $210,000.
So for the same payment, you can borrow more than double the amount of money
since 1985.
So the same, of course, is true in reverse.
Correct.
So take us down the course of what happens when somebody doesn't call you to talk refinance or to lock in a purchase. What happens to that payment as interest rates start to reverse course back to where they will go?
They may not even be able to qualify for the house they're in, and they may not be able to refinance because the interest rates are up, and it may not make sense to do it.
Especially in a refinance situation, you're literally then just saying no to free money.
Correct.
Is it? No, but without just saying correct, I'm going to challenge and push back on you here.
Okay.
Is it just that black and white?
It's just that black and white.
So
Dan.
There's nothing else to it.
There's really nothing else to it. I mean, basically, we can do deals right now that we're doing 0.0 fee, picking up all the costs and saving people hundreds, if not thousands of dollars a month on their mortgage payments. So, I mean, it's because interest rates, because of Brexit, they're at all-time low. And if you take the tax advantages, if you go talk to my boy Mike, take the tax advantages on top of that, I mean, you really could be cutting your payment almost 50. If you're the 40% tax bracket, you could be cutting it in half.
And here's the really interesting thing for a home seller. We were talking with somebody at our home selling workshops, and he's talking about, well, why do I need to know about interest rates if I'm selling a home?
Right. That was a great question.
It was. It was actually a legitimate question that probably other people in the room were thinking.
Yep.
And thank goodness he brought it up. Well, here's why. You're only think about the other side. Okay, there's a buyer involved. They're getting a loan. They can, for the same payment, afford more house. You can represent that more house. And so your buyer pool, we're in a very interesting point in history where you have this heavy buyer pool with all this purchasing power, but little inventory. And as a seller, you can take advantage of selling into one of these buyers. And if you're hooked up with the right buyer specialist, a buyer specialist that can get you out in front of homes that haven't yet hit the market, you're going to win on both ends. Here's what's even more fuel to drive home on this. There is, and this is straight from Forbes, by the way, in today's market, there is a huge amount of pent-up demand, seller demand. Okay, I'm talking pent-up seller demand, meaning people that would typically have already had their homes on the market who are not yet there.
So can I explain this slide to you?
Absolutely.
So typically we tell people that most people stay in their home or their loan from 3 to 6 years. Okay, so if you look at this slide, again, another slide we'll put up on our Facebook page. So in 2008, that held true, right? But then in 2009, we had sellers who stayed in their houses or their loans for 7 years. Then we had sellers in 2010 who decided they're going to stay in their houses for 8 years. Then through 2014, 14, we went to 10 years. But now we're reversing the cycle again. So people also, the thing that people are missing, Dan, in this whole process is that these like short-term ARMs, like the 7-year fix for the sake of argument that you and I have talked about, and we put a whole bunch of your clients in. A lot of people are fearful because they want to be in this 30-year fix. They think they're going to be in their house that long. We're moving back to this cycle of a 3 to 6 year cycle.
From 2001 to 2008, the average home seller, or actually, let me rephrase that. This is actually how to read this. From 2001 through 2008, the average homeowner had been in their home for 6 years.
Then they sold.
Right? Yeah. 6 years and then sold. In 2000, in today, let's just fast forward to today, okay? But today, it's the average homeowner's been in their home for 9 years.
Yep.
So people are in their home longer than the amount of time that people have traditionally been in their home.
Correct.
You have pent-up seller demand that's coming, partially because they don't know what to buy because there's so little inventory for them to purchase.
Correct.
But that problem loops right back to what we talked about in the last segment, which is a quality of agent issue. The problem is that most of them are working with hobbyists on the purchase side. People that are just showing them the next open house to hit the market or the next home to hit Zillow or the next home to hit MLS. So when they're only looking at those homes that everyone else is looking at, they get stuck in a place where they're just part of the mob. To get out in front of it, you need a buyer specialist that'll go out and, well, first of all, will sit with you, do a full needs analysis, understand exactly what you're looking for, and go out, dig that property up, regardless of if it's publicly listed or not. That's where value is created. This has been a great day here, sitting with Michael Khalil, CPA of Mac Financial Inc. Find him. Todd and I endorse him, think he's great. His number is 858-263-1770. I'm Daniel Beer on behalf of the Daniel Beer Group.
I'm Todd Pianin from Home Street Bank, a member of the FDIC, equal housing lender, NMLS ID number 304014. You can find us on Facebook, iTunes. You can find us anywhere or give us a call at 800-676-2420. 800-676-2420. Have a great Sunday, everybody.